1,000 identical units in one warehouse. Two completely different profits. From nothing but a policy choice. Inventory looks like the simplest thing on a balance sheet. Count the boxes, add up what you paid. But IS2 is where two identical companies can report profits 2,400 euros apart and both be completely correct. Inventories are assets held for sale in the ordinary course of business, assets in the process of production for that sale, or materials and supplies to be consumed in production. Finished goods, work in progress, raw materials, and notice what defines them. Not what they are, but that you intend to sell them. A building is inventory to a property developer and property plant, and equipment to everyone else. Before the mechanics, the boundaries, because IS2 hands several things to other standards. Work in progress on construction contracts goes to IFRS 15. Financial instruments go to IFRS 9. Biological assets and agricultural produce at the point of harvest go to IS 41. And then, at that fair value, become IS2 inventory. Spare parts are inventory unless they meet the definition of property, plant, and equipment under IS 16. And two groups measure at fair value less cost to sell instead of the normal rule: producers of agricultural and mineral products, and commodity broker traders. Two of those cost rules do real work against manipulation. Here's the first. What goes into cost? 3 buckets: purchase cost, the price, plus import duties and non-recoverable taxes, plus transport and handling, less trade discounts and rebates; conversion cost, direct labor, plus production overheads, and other costs, but only those incurred in bringing the inventory to its present location and condition. Then the exclusions, which matter just as much: abnormal waste, storage, unless it's a necessary part of production, administrative overheads, selling costs. None of those may sit in inventory. They go straight to expense. Borrowing costs can only be capitalized where IAS 23 lets them. And one rule inside conversion costs does real work against manipulation. Fixed production overhead is absorbed into units based on normal capacity, not on what you actually produced. So if a factory that normally makes 10,000 units only makes 5,000 this year, it cannot push the whole year's fixed overhead into those 5,000 units and park it on the balance sheet. The unabsorbed half is expensed immediately. Without that rule, a company could hide the cost of idle capacity inside inventory. IAS2 also permits standard cost in the retail method, but only where the result approximates actual cost. So that's cost. But cost is only half the rule, and the other half is what stops inventory being overstated. Inventory is measured at the lower of cost and net realizable value. Net realizable value is the estimated selling price in the ordinary course of business, less the estimated costs of completion and the estimated costs necessary to make the sale. Note that it's an entity-specific figure. It is not fair value, and the standard says so explicitly. So the test is simple. What did it cost you? What will you actually net from selling it? And you carry the lower of the two. Two things about that write-down. First, you compare item by item, not across the whole warehouse. You cannot offset a profitable line against a loss-making one. Second, the write-down is not permanent. If the circumstances that caused it change and net realizable value recovers, IS2 requires you to reverse the write-down, capped at the original cost, so you can never write it back above what you paid. That reversal is a requirement, not a choice. And note that IS 36 has nothing to do with any of this. Impairment of inventory lives entirely inside IS2 through the net realizable value test. That's the rule. Now where it actually bites, industry by industry. So where does this actually bite? Net realizable value is where prudence stops being a principle and becomes a number. and it lands differently depending on what you sell. Technology and electronics. Obsolescence is the killer. The moment a new chip generation launches, last year's model cannot be sold at list price, and net realizable value collapses while the goods are still physically perfect. Fashion and apparel. It is the calendar, not the condition. Winter coats sitting in a warehouse in March will be sold at markdown. So net realizable value is the expected markdown price, less the cost of selling it. And the judgment is how deep that discount has to go. Food and pharmaceuticals. A shelf life is a clock. Stock approaching expiry may have no net realizable value at all, and if you have to pay to destroy it, the deduction for costs necessary to make the sale can wipe out the entire carrying amount. And slow-moving spare parts. Nothing is wrong with them, they simply are not selling. So companies provide by age bucket rather than item by item. But here's the trap that catches people in every one of those industries. If you hold raw materials and their market price falls, you do not automatically write them down. Paragraph 32 is explicit. Materials held for use in production are not written down below cost if the finished products they go into are still expected to sell at or above cost. So a manufacturer whose copper drops in value keeps the copper at cost, provided the finished cable still sells profitably. You only write the materials down when the fall in their price signals that the finished product itself will now sell below cost. Take Meridian. If its raw material costs 8,000 euros and the market for that material halves, but the finished unit still sells at a profit, the 8,000 stays. Prudence is not the same as pessimism. IAS 2 asks for a judgment about the finished product, not a reflex about the input. Now, the part that actually moves reported profit. And it's just a choice of formula. Let's actually calculate it, because this is where the formulas stop being names and start being numbers. Meridian Limited buys 1,000 units in 2 lots. 400 units at 50 euros, 20,000. Then 600 units at 70 euros, 42,000. So 1,000 units on hand, costing 62,000 euros in total. It then sells 700 of them at 80 euros each, so revenue is 56,000. The question is, which 700 units you just sold? And that is the only thing the formulas disagree about. First in, first out assumes you sold the oldest stock first, so you work down the layers. The first 400 units came in at 50 euros, that is 20,000. You still need 300 more, and the next layer is at 70. 300 times 70 is 21,000. Add them. Cost of sales is 41,000. What is left on the shelf is the 300 newest units, all at 70. So closing inventory is 21,000. Notice the 2 add back to 62,000. Every euro you paid is either in cost of sales or still on the balance sheet, never lost and never invented. Weighted average does something completely different. It refuses to track layers at all. You take the total cost, 62,000, and divide it by the total units, 8,000, giving one blended rate of 62 euros a unit. Then every unit is that price. 700 sold times 62 is 43,400 of cost of sales, and the 300 left are 18,600. Those also add back to 62,000. So those are the numbers. Here's what they do to the accounts. So put the 2 side by side on the same 700 units. First in, first out gives cost of sales of 41,000, so gross profit is 15,000. Weighted average gives 43,400, so gross profit is 12,600. A difference of 2,400 euros in reported profit, from nothing but the assumption about which units left the warehouse. And look at what it does to the balance sheet. First in, first out leaves 21,000 of inventory. Weighted average leaves 18,600. In a rising market, first in, first out always reports the higher profit and the higher inventory. because it charges the old cheap costs to profit and leaves the new expensive ones on the balance sheet. Weighted average smooths it. Neither is wrong. Both are permitted. They simply tell you a different story about the same warehouse. So which formula may you use? IAS-2 permits first in, first out, and weighted average cost. It also permits specific identification, but only for items that are not ordinarily interchangeable. And it prohibits last in, first out outright. It has since the 2003 revision. The reasoning is straightforward. Last in, first out rarely reflects the actual physical flow of goods, and in a rising market, it leaves the oldest, cheapest costs sitting on the balance sheet, understating what the inventory is really worth. Whichever formula you choose, you must apply it consistently to all inventories of a similar nature and use. You cannot switch between them, line by line, to flatter a result. And that write-down we talked about? Which formula you chose changes how big it is. Now watch what happens when net realizable value bites. Meridian has 300 units left, and net realizable value falls to 58 euros, 17,400. Under first in, first out, those units are carried at 70 each, 21,000. So it writes them down and takes a 3,600 euro loss. Under weighted average, they're carried at 62, 18,600. So the write down is only 1,200. Identical physical stock, identical market conditions, and a write down 3 times larger under one policy than the other. But here's the part almost nobody points out. Take the write down off each gross profit, and both companies land on exactly 11,400. They converge, and they must, because closing inventory now sits at net realizable value under either formula. So the total cost charge is the same, 62,000 less 17,400, whichever route you took. The cost formula moves the shape of your income statement, not the total, in the year net realizable value binds. It moved the total in the good years before the write down. That is the honest version of the story. When inventory is sold, its carrying amount becomes an expense in the period the revenue is recognized. That's the matching that cost of sales exists to achieve. And the disclosures are where a reader can actually check all of this. The accounting policy, including the cost formula used, the carrying amount by classification, the amount recognized as an expense in the period, and, importantly, the amount of any write-down and any reversal, with the reasons for the reversal. That reversal disclosure exists precisely because it's a judgment that flatters profit. One more change is coming, and it affects how all of this appears on the page. Now, the most recent thing you need to know, because it changed how net realizable value is calculated in practice. In June 2021, the IFRS Interpretations Committee published an agenda decision on the costs necessary to sell inventories. The question was simple. When you work out net realizable value, do you deduct only the extra costs caused by the sale, or every cost needed to make it? Many companies have been deducting only the incremental ones. The committee concluded that you deduct all costs necessary to make the sale, and that this is not limited to incremental costs. So fixed selling overheads, storage that is needed to get the goods sold, an allocated share of a distribution facility. If the cost is necessary to make the sale, it comes off. That lowers net realizable value, which means more inventory fails the lower of test and more write-downs get recognized. Note also what IAS-2 itself has not done. Apart from consequential changes, it has not been substantively amended since the 2003 revision. The standard is stable. The movement is in how it is applied. And IAS-2 completes the asset family. Something physical you use in the business, IAS-16. No physical substance, IAS-38. Held to earn rent or for capital growth, IAS-40. held to sell in the ordinary course, IS2, here. And when values fall, IS36 tests all of them, except these. Inventory is the one asset IS36 explicitly does not touch because IS2's net realizable value rule already does that job. Buy it, value it, test it, sell it. From January 2027, IFRS 18 replaces IAS 1 and changes where all of this is presented. Cost of sales lands in the operating category, and so does any net realizable value write-down or reversal. IFRS 18 also requires operating expenses to be presented by nature or by function, which directly changes how the cost of inventories appears on the face of the statement. Not one number in IAS 2 changes. The statement it lands on does, and because IFRS 18 applies retrospectively, 2026 comparatives are already being restated. That's the mechanics complete. Now, what it means if you're reading the accounts. What should an investor take from this? Two things. First, read the cost formula in the accounting policy note before you compare gross margins between two companies. Two businesses holding identical stock can report different cost of sales purely because one uses first in, first out, and the other weighted average. And in a rising market, that gap widens. Second, watch write-down reversals. A reversal increases profit without a single extra sale, and IAS2 requires the reasons to be disclosed precisely so you can judge whether the recovery is real or convenient. Meridian on the actual statements under first in, first out. Revenue, $56,000. Cost of sales, $41,000. Gross profit, $15,000. Then the net realizable value write-down of $3,600, giving a gross profit of $11,400. And on the balance sheet, inventories of $17,400, 300 units at the lower of cost and net realizable value. Every figure traceable to a paragraph. 4 things to carry out. Inventory is the lower of cost and net realizable value compared item by item. Fixed overhead is absorbed on normal capacity, so the cost of idle capacity cannot be hidden on the balance sheet. IAS2 permits first in, first out, and weighted average, and prohibits last in, first out. And a write-down must be reversed when net realizable value recovers, capped at original cost. That's IAS2. 1,000 identical units and 2 permitted answers, 2,400 euros apart. Decided by a policy note most people skip. That completes the asset family. IAS 16, 38, 40, 36, and now IAS 2. See you in the next one.